Hi everybody, Jeff Yastine here. As always, remember to write me to my email address. It's jeff@yastine.com, and you can follow me on Twitter and on Facebook as well. Well, by now you've probably read all about the new stimulus deal. I won't bother going into the details or whether it's enough or not enough. You'll get plenty of that elsewhere. But for investors like us, the bigger question really is, now what? I mean, really, that's what it comes to. What do we do looking forward here? What do we do with this information? And to me, it means more of the same that I've been telling you for months now, which is that the first thought is to keep your focus on not just the rewards, but also the risks, right? This isn't a video game. There are real risks to you losing money here. And it will take time for the stimulus money to move out to the economy, but ultimately it serves as additional support for the stock market. And we need to keep in mind that we may be in a sort of a bubbly melt-up phase here. And in a bubble, crazy things like making a lot of money, but also losing a lot of money can happen very quickly. Now, what stocks have the best risk-reward profile, given the new stimulus alongside the COVID vaccines that are now being distributed in the US and around the world? Well, again, we have to keep thinking, in my view, about energy stocks. Since I started talking about buying energy stocks back in October, the shares for oil companies that I've mentioned are up somewhere between 25 to more than 40%. And all this is happening against the backdrop in which the number of oil rigs in operation is beginning to climb, yet is still far below where it was even a short 12 months ago. And to me, that all says that oil prices are headed much higher in coming quarters. Now, in past videos, I've recommended Exxon, I've recommended Marathon Petroleum, Chevron, and Valero. I also recommended in a separate video Kinder Morgan, which is a pipeline and natural gas company. I think all are good buys here, especially after the sell-off of recent days. And likewise, we need to focus on banks and insurance companies because of rising interest rates. Now, since I started talking about these back in August, the share price for instance, Aflac, which I recommended in a video, is up 15%. I also think that you should consider buying shares of Bank of America, which I recommended in October and is up about 20% since then. One other thing that I think will help bank stocks' performance in coming months, the Federal Reserve recently allowed banks to start repurchasing their own stock again for the first time basically since the financial crisis. And if there's one thing we know about stock repurchasing, it's that for every million shares that a company repurchases in the stock market and removes, it makes the remaining shares that much more valuable. It provides a great tailwind for companies of all kinds that have cash flow. Banks have cash flow. They've been keeping their costs low as well. And I think as interest rates move steadily higher here in coming quarters and in coming years, I think that banks and insurance companies will do very well indeed. Now, emerging market stocks are another great place to look, in my opinion. This chart of EEM, which is a widely held emerging markets ETF, says it all to me. It's at the same price now as it was 12 years ago. And the key reasons why anyone would buy an emerging market stock have not gone away. It's about strong population growth in certain countries and faster rising economic growth, faster than you would get in a mature market like the United States. What has changed is simply that investors in past years have been unwilling to pay higher prices to own a share of those profits, while they're willing to assign a much larger value to owning profits of U.S. companies with some growth. In the months to come, as COVID ceases to be the threat that is now, I think as that happens, I expect investors around the world to shift into emerging market stocks in a much bigger way, since they can buy faster growth at far cheaper prices than the typical US-based NASDAQ growth stock. So there you go. We have the stimulus plan, and if you own your basic high-flying tech stock that's based in the US, chances are much of the impact of that new stimulus legislation is already priced in. In my view, that's not the case if you focus on energy, financials, and emerging markets. For starters, there's other ideas here, but let's start with those three, and we'll move on from there in coming videos. If you like what I'm talking about, again, make sure to subscribe to our YouTube channel, follow me on Twitter and on Facebook. And until next time, I'm Jeff Yastine.